In 1990, a postal worker in Vermont named Theodore Johnson retired with a net worth of over $800,000. He never earned more than $14,000 a year. He never inherited anything. He never picked a winning stock. What he did was put 20% of every paycheck into company stock and leave it alone for 4 decades. Most people hear that story and assume there's a catch. There isn't. Here's what most people believe. Building real wealth requires either a high income, a lucky investment, or both. But something quietly changed in the last century that made neither of those things strictly necessary. The math stopped requiring exceptional inputs to produce exceptional outputs. So where does the gap come from between what you put in and what you actually end up with? That gap is called compounding. And that's what this video is about. Because if you don't understand how it actually works, not the concept, but the mechanics, you will keep interrupting it at exactly the wrong moment. And every interruption is expensive in ways that don't show up until it's too late to fix them. My name is Alex, and if you've ever looked at your retirement account and thought the numbers should be further along by now, stay with this, because the problem almost certainly isn't how much you're saving. I'm going to show you exactly how $300,000 becomes $2 million, and what quietly destroys that outcome for most people who are otherwise doing everything right. Once you understand how compounding actually builds and what breaks it, you'll stop seeing market volatility as a threat and start seeing it for what it really is. The mechanism behind all of it traces back to one simple idea that most people think they understand, but don't. Most people think compounding is simple, and it is, conceptually. But there's a difference between understanding an idea and actually feeling what it does over time. That gap is where most people get into trouble. Here's the mental model that makes it real. Think of your money as having two employees. The first one is you. You show up every month, make the deposit, and do the work. But at some point, a second employee arrives. This one doesn't need a salary, doesn't need health insurance, doesn't take a vacation. This employee takes everything they earned last month and immediately puts it back to work, every single day without being asked. That second employee is compounding. And the reason most people underestimate it is because of when it shows up. For the first 10 years, honestly, it's insulting. You're putting in $800 a month. You're disciplined. You're consistent. And the market's contribution is actually less than yours. You've deposited around $96,000 of your own money. The growth has added maybe $60,000 on top of that. You're doing more work than your employee. That's a demoralizing place to be. And it's exactly where a lot of people quietly give up or start making changes they'll regret. But here's what's actually happening underneath the surface. That second employee is getting stronger, quietly. Every month, the base they're working from gets a little bigger. The returns compound on the returns. The engine is building torque you can't see yet. Jump to year 20. Now the picture looks different. You've put in around $190,000 of your own money. The market has added more than double that on top. Your second employee is no longer keeping up. They're pulling ahead. The relationship has flipped. And once it flips, it doesn't flip back. Then you hit year 30. This is where the math becomes almost hard to believe. In just the final 10 years alone, years 21 through 30, the growth adds over $1.2 million to the portfolio. You contributed roughly $96,000 during that same decade. The market added more than 12 times what you put in. That's not a typo. That's the geometry of compounding in its final stage. And it looks nothing like the first 10 years. Here's what that looks like in total. $800 a month for 30 years at a 10% annual return, which is roughly what the S&P 500 has averaged over the last 100 years, including the crashes, the recessions, and every crisis that felt unsurvivable at the time. You put in around $288,000 of your own money. You end up with just over $2 million. The other $1.7 million was generated by your second employee. You didn't earn it in any traditional sense. You just didn't fire him. And that's worth sitting with for a second. $1.7 million. Generated not by working harder, not by finding the right stock, not by timing the market. Generated by staying out of the way long enough for the math to finish its job. Now, there's a moment in this journey, somewhere around year 25, where something remarkable happens. Your second employee starts earning more in a single year than you ever contributed in total across all 30 years. Think about what that means. The money you saved becomes almost irrelevant to the outcome. The employee is running the show. Your deposits are background noise. That's the tipping point. And it's also the moment that makes the next part of this story so painful to watch. Because here's the thing, knowing all of this doesn't protect you. Understanding compounding intellectually doesn't stop you from doing the one thing that destroys it. And most people do destroy it. Not through fraud, not through bad luck, not through picking the wrong fund. They destroy it through behavior, through the completely human, completely understandable panic that hits when the market drops and your account balance looks like it's falling apart. That gap between what the market returns and what the average investor actually keeps, that's what we need to talk about next. And it has a cost, a specific, calculable, devastating cost. Researchers have been tracking it for decades, and the number will make you uncomfortable. There's a statistic that should be taught in every high school economics class, but isn't. It's not complicated. It's not hidden. It's been published every year for decades, and it explains, more than almost anything else, why people who do everything right still end up with less than the math promised. Over the last 20 years, the S&P 500 returned an average of 10.2% per year. That's the number. That's what the market gave. But the average investor, the actual human being sitting in those same funds, with access to those same returns, captured 6.8%, not 10.2, 6.8. That gap isn't explained by fees. It isn't explained by bad funds or bad luck. It's explained entirely by behavior, by the specific, predictable, deeply human pattern of selling when things look terrifying and buying back in after the recovery has already happened. The market gave everyone 10.2. Most people handed back 3.5 points without realizing it. Now let's put that in dollar terms, because the percentage gap is easy to dismiss. The dollar gap is not. Take someone like David, a high school teacher in Ohio. He starts investing at 32, $800 a month, consistent, never misses a contribution. Over 30 years, he has put in just under $290,000 of his own money. If David stays the course, doesn't panic, doesn't sell, captures the full market return, he ends up with just over $2 million at retirement. That's the math working exactly as advertised. Now take the same David, same income, same contributions, same funds. But this David behaves like the average investor. He sold in 2008 because the headlines were catastrophic, and his balance had dropped 30%. He waits on the sidelines for 14 months, then buys back in after the recovery is already underway. He does something similar in 2020, and again in 2022. Each time completely rational in the moment, each time expensive in ways he won't fully understand until it's too late. That David ends up with just over $1 million. Same market, same starting point, same monthly deposits. $1 million difference. Not because of a bad investment, not because of fraud or bad timing in any structural sense. Because of the gap between what the market offered and what he actually allowed himself to keep. That's the behavioral tax. And unlike income tax or capital gains tax, nobody sends you a bill for it. It just quietly disappears from your future. Here's what makes it so hard to avoid. The moments that trigger panic selling are designed, by their nature, to feel like the rational response. When the market drops 20% in a month, selling feels like damage control. It feels responsible. Every instinct you have, the same instincts that kept your ancestors alive, is screaming at you to stop the bleeding. The problem is that those instincts evolved for a world where losses were permanent. A predator ate your food. It was gone. Markets don't work that way. The drop is temporary. The sale is permanent. And the data on what happens after panic selling is brutal. Missing just the 10 best trading days in the market over 20 years cuts your final return almost in half. 10 days out of roughly 5,000 trading days. That's how fragile the outcome is to behavior. That's how much of the $2 million journey happens in moments you can't predict and can't afford to miss. So the behavioral tax isn't a character flaw. It's not a failure of discipline in some moral sense. It's a structural problem. The way markets move, the way financial media covers volatility, the way our brains process loss, all of it is working against the patient investor at exactly the moments that matter most. Knowing that doesn't make it easier to sit still during a crash. But it does change the question. The question stops being, should I do something? And starts being, how do I make sure I don't? Which brings us to the second threat. And unlike the behavioral tax, this one doesn't announce itself at all. It doesn't spike your cortisol or show up on the evening news. It works slowly, silently, every single day. a steady drain on your portfolio that most people never think to calculate. It has a name, and once you see what it actually costs, the fee drain will change how you look at every fund you've ever owned. Nobody wakes up and decides to give away $500,000, but a lot of people do it anyway, slowly, quietly, in amounts small enough to ignore, until the day they run the numbers and realize what actually happened. This is the fee drain. And it is the most polite way the investment industry takes money from people who don't know how to look for it. Here's how it works. Every fund you invest in charges a fee. It's called the expense ratio, and it's expressed as a small percentage of your total balance, taken automatically every year. You never write a check. You never see a line item. The fee just quietly reduces your return before the number ever hits your account, which is exactly why most people have no idea what they're actually paying. The average actively managed mutual fund in the United States still carries an expense ratio somewhere between 0.5 and 1.5% per year. Some go higher, and the pitch is always the same: professional management, research teams, strategic positioning, superior selection. You're paying for expertise. You're paying for someone to be smarter than the market on your behalf. The problem is that the data doesn't support the pitch. Over any 15-year period, roughly 80 to 90% of actively managed funds underperform a simple index fund that just tracks the market and charges almost nothing to do it. You're paying more for worse results, consistently, at scale. Let me show you what that looks like in practice. Take someone like Caroline, a physical therapist in Arizona. She starts investing at 30, puts in $800 a month, and does everything else right. She's disciplined. She doesn't panic sell. She stays the course for 25 years, but she's in an actively managed fund with an expense ratio of 1.2% per year. Doesn't sound like much. 1.2% feels like a rounding error. Here's what that rounding error actually costs. At a 10% gross market return, her real net return after fees is 8.8%. Over 25 years, she ends up with around $890,000. Not bad. She's done better than most people ever will. Now run the same numbers with Caroline in a low-cost index fund. Expense ratio of 0.03%, which is what the most widely held index funds in the United States charge today. Her net return is essentially the full 10%. Same market, same contributions, same 25 years. She ends up with just over $1,100,000. The difference is $210,000. Gone. Not lost in a crash, not stolen. Just quietly redirected, year after year, in amounts too small to feel but too large to ignore once you actually calculate them. And here's the part that should make you genuinely uncomfortable. That fee didn't just take $210,000 from Caroline's final balance. It took the compounding that would have grown on top of those dollars for the remaining years of her investment horizon. Every dollar paid in fees is a dollar that stops working for you permanently. The fee drain isn't just a cost. It's a compounding cost. It compounds in reverse, shrinking the base that your second employee works from year after year without a single notification. Now, to be fair, there are situations where higher fees can be justified. Specialized asset classes, certain alternative investments, and funds that genuinely provide access to strategies unavailable through index products. The category isn't worthless, but for the core of a long-term retirement portfolio, the evidence is overwhelming and has been for decades. Low cost wins. Not because cheap is always better, but because in investing, every dollar you don't pay in fees is a dollar that stays in the compounding engine. Check what you're paying. Right now, today. Log into your brokerage, find the expense ratios on every fund you hold, and add them up. If the number is above 0.2%, run the 30-year projection. That number will be more motivating than anything else in this video. But fees are a threat you can fix with a single decision. The next one is different. This one can hit you even if you've done everything else perfectly. And the damage depends almost entirely on timing you cannot control. It's called sequence of returns risk. And it's the reason two people can retire with identical portfolios, face identical market conditions, and end up with completely different financial lives. Here's a question that sounds like a trick but isn't. Two people retire on the same day. Same amount saved. Same fund. Same withdrawal plan. One of them runs out of money before they die. The other leaves $800,000 to their kids. What's the difference? Not skill. Not discipline. Not even the market. Just timing. This is the sequence of returns risk, and it is the most underappreciated threat in retirement planning, not because it's complicated, but because it's invisible until it isn't. You can do everything right for 30 years and still get derailed by what the market does in the first 24 months after you stop working. The order of returns matters as much as the returns themselves. Most people have never been told that. Here's why it works the way it does. While you're still contributing, still in the accumulation phase, a market crash is actually manageable. Painful? Yes. Uncomfortable? Absolutely. But recoverable. You're still adding money every month. You're buying shares at lower prices. You have time for the portfolio to rebuild before you need to touch it. The crash and the recovery both happen while your second employee is still working. Retirement changes the equation completely. The moment you start withdrawing, you flip the dynamic. Now you're selling shares every month to fund your life. And if the market drops 40% in year one of retirement, you're not just watching your balance fall. You're selling shares at their lowest price to cover your groceries, your mortgage, and your insurance. You're locking in losses in real time. And the shares you sell at the bottom are gone permanently. They can't recover for you because you no longer own them. Let me show you exactly what that looks like. Take two retirees. Robert, a recently retired civil engineer from Pennsylvania, and Susan, a retired nurse from Colorado. Both retire with $1 million. Both plan to withdraw $50,000 a year to live on, adjusted for inflation. Both invest in the same fund, which delivers an identical average annual return over their retirement. The only difference is the sequence of those returns. Robert retires in a bad year. The market drops 37% in year one and another 12% in year two. He has to sell shares at rock bottom prices just to cover his withdrawals. By the time the recovery comes, his portfolio is too depleted to fully participate. He runs out of money at 81. The math simply doesn't recover from those early losses. Susan retires in a calm year. The first decade of her retirement is relatively stable, with solid positive returns. Her portfolio grows while she withdraws. Then the same crash hits. Same magnitude, same duration. But 20 years into retirement. By that point, her portfolio has had 2 decades to compound. It absorbs the crash without threatening her income. She lives comfortably through her 80s, and when she passes, her estate still holds over $800,000. Same money, same market, same average return. Completely different outcomes. That is the sequence of returns risk in practice, and it is not a fringe scenario. It is a structural feature of how retirement withdrawals interact with market volatility. So what do you actually do about it? The fix isn't complicated, but it requires building it before you need it. The most effective defense is a cash buffer, 1 to 2 years of living expenses held in cash or short-term instruments outside your investment portfolio. Set aside before you retire. Think of it as a firewall between your life and the market. If the market drops 30% in your first year of retirement, you don't sell a single share. You live off the cash. You give your portfolio time to recover. You stop the forced selling that turns a temporary crash into a permanent loss. It sounds almost too simple, but the math behind it is serious. A 2-year cash buffer can extend a retirement portfolio's longevity by years, sometimes decades, depending on the sequence you happen to draw. It doesn't require predicting the market. It just requires accepting that the sequence is outside your control and building a structure that makes the sequence irrelevant. You've now seen all 3 threats clearly: the behavioral tax, the fee drain, and the sequence of returns risk. Each one can derail the $2 million outcome on its own. Combined, they're the reason most people end up with a fraction of what the math promised. Which means the final question is straightforward. What does the 3-step playbook actually look like to defend against all 3 at once? Most financial advice fails not because it's wrong, but because it arrives without a delivery system. You understand the concept, you agree with the logic, and then life happens, the market moves, and the understanding evaporates exactly when you need it most. So the question isn't what to do. By now, you know what to do. The question is how to build a structure that keeps you doing it when every instinct you have is pushing in the opposite direction. That's what this playbook is. Not a set of ideas, a set of rules you build before the pressure arrives, so that when it does, the decision is already made. Step 1. Get your costs down, all the way down. The target is an expense ratio below 0.2%, not below 1%, not below 0.5%, below 0.2. The most widely held index funds in the United States today charge between 0.03 and 0.1%. That range exists. It's accessible to anyone with a brokerage account. There is no longer a credible argument for paying significantly more than that for core retirement exposure. If you don't know what you're currently paying, stop the video and find out. Log into your account, pull up each fund you hold, and look up the expense ratio. Then run a simple projection. Take the difference between what you're paying and 0.2%, apply it to your current balance, and compound it forward 30 years. The number you get is not a fee. It's the cost of not switching. For most people, that number lands somewhere between $200,000 and $500,000. That tends to clarify the decision. Step 2. Build an interference calendar. This one sounds almost too behavioral to take seriously. It isn't. The interference calendar is a pre-committed rule, written down before any crisis happens, that states the following. Before taking any action on your investment portfolio in response to market movement, you will wait 72 hours. No exceptions, no conditions. 72 hours. The reason it works is simple. Panic selling almost never survives 3 days of reflection. The urgency that feels overwhelming in the moment, the certainty that this time is different, that the market won't recover, that getting out now is the rational move. That feeling has a half-life of roughly 48 hours. The interference calendar doesn't stop you from making the decision. It just ensures you're making it with a brain that isn't flooded with cortisol. Write it down. Put it somewhere you'll see it when the moment comes. Tell someone else about it so there's a small social cost to breaking it. The mechanical simplicity of this rule is the point. Complexity fails under pressure. Simple rules hold. Step 3. Design your retirement withdrawal strategy before you turn 60. Not at 60, not when you're close to retiring. For 60, while you still have time to build the structures that protect you from the sequence of returns risk. This means 2 things specifically. First, calculate your annual withdrawal number now. What does your retirement actually cost per year? In today's dollars? Most people have never done this calculation with any precision. Do it. Then multiply by 1.5 to account for inflation and unexpected expenses. That's your target withdrawal number, and everything else gets built around it. Second, start building the cash buffer at least 3 to 5 years before your retirement date. 1 to 2 years of living expenses, held outside your investment portfolio, in cash or short-term treasury instruments. Not invested, liquid, available. This is the firewall we talked about in the last section. The earlier you start building it, the less disruptive it is to your overall portfolio, and the more confidence you carry into retirement knowing that a market crash in year 1 cannot force you to sell at the bottom. 3 steps. Lower the costs. Create the pause. Build the buffer early. None of this requires sophistication. None of it requires a financial advisor, a complex strategy, or above-average market knowledge. What it requires is building the infrastructure of good decisions before the moments that test them arrive. Because here's the honest truth about the journey from $300,000 to $2 million. The math is not the hard part. The math has worked reliably for a century. The hard part is the 30 years of staying out of your own way while it does. And that brings everything full circle, back to where this started and to what it actually means for the decisions in front of you right now. Here's what this all comes down to. The journey from $300,000 to $2 million is not a fantasy built on exceptional luck or exceptional income. It is a system, a century-old, historically verified system that works reliably when you let it and fails reliably when you don't. The reasons people fail are not random. They are predictable. Behavior costs more than bad investments. Fees compound in reverse, just as reliably as returns compound forward. And the sequence of what happens in your first years of retirement can matter more than 30 years of disciplined saving. What changes when you understand this isn't just your portfolio. It's the way you read market news, the way you respond to a down month, the way you think about the funds you're sitting in right now. The next question worth sitting with is this. If compounding is this powerful over 30 years, what happens to the people who figure this out at 25 instead of 35? That's a different video, but it starts with the same engine. If this reframes how you think about your own money, share it with someone who's still trying to figure out why the math isn't adding up for them.